Stephen King is with me, the Senior Economic Advisor at HSBC. He's with me from London. The irony of all of this, Stephen, is that the medicine central banks are administering, I mean, this is exactly what it's intended to do. Slow things down, take the pressure out of asset prices, puncture that bubble, if you will. But it's going to be very brutal, as it's now becoming clear.
You're absolutely right, Richard. So the big problem, frankly, is inflation, not so much recession. The inflationary numbers on either side of the Atlantic have been, frankly, far worse than any of the central banks had expected. They all have their excuses for why inflation is so high, whether it's Russia, Ukraine, whether it's shortages associated with the pandemic. But I think the reality is that they themselves have left monetary policy too loose for too long. They hope to stoke up demand, to build back better, or whatever they wanted to do. But when supply itself is heavily constrained, you're likely to end up with a bit of an inflationary problem. So the inflation numbers are so incredibly high now compared with anything we've been used to over the last 20 or 30 years. And in these circumstances, there's a danger that central banks have got behind the curve, so to speak, that they haven't done enough. So they're kind of, in one sense, afraid of a recession coming along, but also fearing that perhaps a recession might eventually be necessary to get that inflation problem back under control, because it certainly isn't under control at the moment.
So you not only have higher interest rates, which will cause people to pay more on credit cards, loans and mortgages, for example. You also have higher inflation, which raises the weekly shopping bill. But you also have the wealth effect going into reverse, don't you? People seeing tonight, I'm X poorer on my portfolio or on my pension or whatever, and therefore they stop spending, and that feeds into this downward spiral.
That's absolutely true, but there's one catch to this, which is, of course, that stock markets in particular did incredibly well during the pandemic. I mean, a remarkable feature of the pandemic was that we had collapsing economic activity in many parts of the world because of lockdowns, but at the same time, simultaneously, you had these very, very strong gains in stock markets. So although they've weakened a bit this year, the reality is that an awful lot of people are quite a lot richer financially than they would have been 2 years ago. Also, it's worth stressing that labour markets are actually still pretty tight. Unemployment rates are very low. Vacancy levels in the UK are incredibly high. So I suspect what we're also going to see, that hasn't been talked about quite so much up until now, is that, yes, prices will be going up and that will squeeze people's incomes. But at the same time, I think in some cases, wages also will be rising. Now, when you've got wages and prices rising simultaneously, that again suggests that perhaps monetary policy isn't tight enough. So we're going to have to take quite a lot more of this rather unpleasant monetary medicine before this whole process is really under control, I fear.
There's a million and one sort of too clever by half questions that I could ask you, but I guess trying to imagine what our dear viewer wants to know tonight, how long is it going to last? How long before there will either be a reduction in inflation? Because we do know how to get rid of inflation. I mean, it's not some great magic trick. We know what needs to be done. But how long before you would expect to see inflation coming down?
Well, first of all, it's worth stressing that inflation has been a lot higher than people had expected, and consistently so. Even before Russia, Ukraine, even before the latest increase in energy prices, inflation was rising more than people had thought. As far as the future is concerned, I think there's an inconsistency in markets currently. You've got some people saying, well, a small amount of rate increases will do the trick. It'll get inflation back down to where we'd like it to be. But I suspect relative to that kind of expectation, either interest rates will have to rise a lot further to get inflation back to the kind of 2% numbers we've been used to, or alternatively, interest rates won't go up that much. But in that case, we're likely to end up with inflation persisting for far longer. So this combination of small rate increases and big effects on inflation, that I think might be too optimistic at this stage.
Is it likely? I'll give you a range of options. Maybe, possibly, probably, likely that we are going to see a coordinated recession by accident between the Eurozone, the UK and the US.
Well, it's worth stressing, and I'm being a little bit vague here, I'm afraid, Richard, but it's worth stressing that Europe in particular, Europe and the UK are facing a bigger problem than the US because they're much more exposed to what's going on in Russia and Ukraine, particularly in terms of energy prices and gas prices in particular. So in terms of recessionary risks, they're probably greater in the UK and in the Eurozone than they are in the US. And to be fair, today the Bank of England effectively has admitted that by saying there's a danger of the economy shrinking at some point over the course of the next few quarters. But overall, history would suggest that when you've got inflation up at sort of close to double digits or at double digits, and you've got tighter labour markets coming through, then the kind of monetary tightening you're going to require may well increase the risks of recession, uncomfortably so, I would suggest, over the next few quarters.